Good afternoon, everyone, and welcome back to the new video. This video is a part of our playlist where we cover John Sear book and summarize all the chapter. We are on chapter number 15, and that is among the very important and most important chapter, that is Black-Scholes formula or BS formula. Everyone know it. It is used for deriving the option fair value of option price, right? So let's go to our board without any delay. So BS formula, right? In 1970 Fisher Pratt, Leon Scholes, and Robert Milton, they they three of them achieved a major breakthrough in economics and finance by deriving Black-Scholes formula, right? They did the feature, I guess, Robert Milton, Robert Milton, and Robert Milton, and that is another Meron Scholes received a Nobel Prize in 1995 for their breakthrough, and sadly, Fisher Black has died before it. And if he would be alive, he would also got the Nobel Prize. And the both approach deriving the Black-Scholes formula was the Fisher Black and Meron Scholes approach was using capital asset pricing model and an arbitrage. By using an arbitrage formula, arbitrage market, they derived the formula. But the Robert Milton constructed a risk-free portfolio that we uh, run in binomial chapter, risk-free portfolio, and then pricing the European option in risk neutral world, right? So in this chapter we will cover the Melton approach to derive the Black-Scholes formula. Let's uh, go through few property of our variable, random variable, right? So log number property, let's say the stock return or percentage change in very small time stamp is log normal, is normally distributed at very small time step at delta t. The data is normally distributed, and if we take a whole period, the whole stock price follow log normal property or log normal distribution, right? That is log normal distribution, and normal is right. So it gives it state that during slight change of s is a stock price, that will give the value of normally distributed with mean mu delta t, mu dot delta d, and variance term is here. So standard deviation would be t, sigma t, right? And so to model, sorry, my net is not working. So as we know, we use log form of data or log form of SO or a geometric Brownian motion to model stock behavior, like stock dynamic. So this dynamic under the distribution, the mean and variance under the normal log form of percentage change would be like this: log of SO ST minus SO, that is normal distribution, with log sigma mu minus sigma 2 times t and sigma square t, right? And then by the property of log, it would be divide ST by SO, that would be, sorry, mu minus sigma square upon 2 t, and it would be remain same, right? This is log normal distribution, and this doesn't mean it is a mean or it is a variance, because the mean and the log normal mean of the formula is not the real mean of the distribution or data, right? You have to remember that log st, it is just a drift term, it is not real mean. That is log of SO plus mu, and after doing upon 2, sorry for my low energy, I am not feeling well, so let's continue. So this is the distribution of log normal stock return, right? You have to remember this formula upon sigma square p. And yeah, so there will be problem like numericals, like example 15.1, where the SO is initial stock price 14, the expected return, that is expected return, not mean of the data. You have to remember that, huh? Expected return, okay. Mu is 60%, that is 0.16, and volatility is 20%. So we have to find the equation probability distribution, probability distribution of stock price within 6 months, right, with confidence interval of 95%, right? So first we will put the value of it, log 40, log 40 and 0.16. We will put all the value, right, and 0.2 square into 0.5. Let me improve my handwriting. Why? Sorry. I will try to write it properly. And let's say, so after solving, that is log of log st is from distribution where its mean is 3.75, expected return is 3.75, and variance is 0.02, right? And then with the 95 confidence interval, so it z score or derivation is come to 1.96. So we will multiply it from 1.96 between st and then minus 1.96. So it will go like the expectation would be negative minus 1.96 into 0.41, and 0.141 is standard deviation of 0.02 equal to 0.141. That would be log of st would come here, and then we will do the same 3.759 plus 1.96 into 0.141, and that would be our value would be, we have to find the log, that is exponents, okay. Final value of this here, log of st, sorry, log will remove, and then that value here, and the final value would come to, and this, that's how the Monte Carlo simulation also work. You can get the idea of expectation that it would be between 32 and 56. And yeah, that's what I wanted to show you. So the expectation of xt formula, we know that we have studied. It is simple so for log normal distribution. It is slightly changed here is it is a mean divided by t, and variance formula for log normal is that this formula is so square upon e raised to square mu t and in bracket of e sigma t minus 1, that is 15.5 formula, right? And then let's go to distribution rate of return, right? So what I told, in small time step or continuous compounding, the data is normally distributed, right? Normally distributed, and in wrong form with wrong period of time, the stock price follow wrong normal distribution, right? So rate of return at small pace is normally distributed, and that can be derived with equation like st equal to so e x t, where e is the drift term or a mu, x is a mu, and that is a t, right? Then we will derive the x maybe into simple let's say simple algebra, and that would be log of st upon so, and then it follows the log. So we will put the value here, and the final value would be like this. We will put the value of log normal distribution from above, and I am not doing it. So final value would be x belong to phi mu upon sigma square 2 and sigma square t. Okay, that's the let's say, yeah, that's the whole name, that is normal distributed with mu. Here it is a mean of mu minus sigma square 2 and st standard deviation of sigma dt. Okay, and let's say that's the expected return. Let's go to expected return. You have to understand what is how the mean and the normal distribution, which part of variable come from log normal, how the process follow it, to understand the Black-Scholes formula, and this will all make sense when you will derive the BS formula. And let's focus on expected return now. So we know that higher the risk, higher the risk, higher the return, right? So in risk neutral valuation or risk neutral portfolio, the risk free rate is used, that is fixed rate of zero coupon bond or FD, for your better understanding that the market can't give. You invest anywhere it can give return or more than 0. Let's say 5%. So there is no extra beneficial or extra incentive given to a person with a huge money or a huge risk appetite. So our mean expected return mean of return is given by formula mu delta t. Delta t is the mean over that period of time. So let's say we have to the mean of this is log normal, right? For small delta t, it will be normally distributed with mean delta t and variance variance d and sigma t. That's the logic behind, and this it came from a formula that we see 1 by t log of st and so where expected return expected of x is given by mu minus sigma square by 2, right? So let's derive the formula. So for log normal process, right? For ST, that would be SO EUT. And now we will take log of both side. So log of expectation would be log of SO, because it is a, sorry, multiplication we add plus, and the log of E is 1. This come ahead, right? Basic formula, and that's the formula for expectation written. And next topic is volatility. Randomness, the unsureness or unpredictable part that follow Brownian motion or diffusion part, you can understand. So the in majority of time, it volatility is between 15 to 60%, and the variance is shown by this, and the percent change over a small time, that is mean. So the standard deviation is our sigma, that would be delta P upon sigma, right? And that's how it work. And so the volatility over time is given is given by volatility per annum, volatility per day, into number of trading day. So if we have 30% volatility, let's say, per day, we will multiply it like this. Sorry. With 252 days for 1 year every day, right? So that's how it worked, and it is simple. And so for 1 week, it would be simple, right? 30, if the standard deviation is 30 into square root of 1 time, right? Standard deviation into delta t, and delta t 1 upon 52, that is 4.116 per day with respect to week, right? And you can multiply it, and it's simple mathematics, and you can do it. So there is a trading day and calendar day, right? So for a trading day, holiday is not there, and calendar day or 365 is there. For making our calculation easy, we skip the holiday, and we just our training day is of 252 days, and that's the important thing to remember. So we are close. We are close on deriving BS differential equation, and we will make it by portfolio construction method in risk neutral world. Okay, so we all know that. So our condition would be non dividend paying stock, the arbitrage free market, complete market theory, and we will construct in risk neutral world, and portfolio will consist of consist portfolio will include a position in stock and in position in option, right? Let me stop. Okay. And position in derivative, right? Option, right? And the good part is these parties will be correlated because the effect of stock price increase would affect the both of it, and decrease would affect the stock, even the option value. And let's create our portfolio, risk based portfolio. So let's say this is stock price, and at very small change we will find the slope or a rate of change, let's say derivative. Okay, so it would be derivative of c equal to 0.4 derivative of s, the slope value, right? X2 minus x1 or y2 minus y1. I think the slope value is like this, right? Finite differential method and everything. So it says that we will short 100 call option and take a wrong position in 40 shares, right? So that's would be our formula. So in BS there is a assumption that there is a continuous rebalancing of portfolio. The slope of portfolio would change, right? So today is 0.4, tomorrow 0.5. So to maintain the 0.5, we will buy and sell constantly at that every given time. That is not possible, but for mathematics we can taking this assumption. So there is a more assumption, right? So more assumption is stock price for a GBM and with mu and sigma. Second assumption is there is a short selling, uh, full short selling without any margin. Let's say there is no restriction, right? Everything is no transaction cost, no dividend during life, no riskless arbitrage opportunity that we discuss, no arbitrage, and security of trading is continuous at every time step, and it is in a risk-free market with return of R, right, for all maturity. And let's start the derivation of our BS differential SD, stochastic differential equation. And I am very happy to say that I very enjoyed the derivation of SD, yet I did not understood the boundary condition of solving the formula, the last formula. So let's say ds equal to, that is our geometric Brownian motion, SDT plus sigma s, that is, this is our Brownian motion, our drift term, our diffusion term. The term with Brownian motion is called diffusion term. All the basic, then we will apply the Ito's lemma to it. Apply Ito lemma, and the Ito lemma is as simple as df by ds mu s plus df by d uh, rho, इसको क्या डेल्टा नहीं, partial derivation with respect to t plus df second order derivation half sigma square s square, and that would be dt, and plus diffusion term our df ds s dz. Okay, that's simple. It is the discrete version, we know that. Now we will discrete version, we know that delta s equal to mu s delta t plus sigma s delta t. Simple. And the discrete Ito-Rama formula is first order first order differential equation set with respect to time, partial second order sigma square s square plus f s delta z, right? Okay, so our process, let's say f process, right? Some process of st and s, and s process stock price, the both have same dz. The Brownian motion correspond to that equation is same, right? So we can eliminate this, the small change of that, and that would give us a new portfolio where we can rebalance at small time stem. It is for delta s and delta f for small time stem there we can short our one derivative and would buy a this amount of stock, that is delta amount of stock, that is same portfolio that we used earlier, but now it is for very small time of time. You have to understand, first we consider whole Brownian motion, right? Our f st, and this is our st. The f is a function of s and t, and then we saw that it the both Brownian motion are same. Then we eliminate the randomness. Then we took the small part of the equation and see the observe the change, and then we can say that we can construct the small portfolio with derivative, one short position in derivative and delta amount of wrong position in share. So our new portfolio, right? Our new portfolio would be minus f, that is a function of derivative, plus f upon s, right? And the small change, let's say small change in portfolio dynamics would be minus delta f plus, right? And if we substitute equation 12 and equation 13, then delta pi equal to minus 1 upon p minus, so I completed half the chapter and I saw that the video was on the pause. So it's my bad. Let's start where I paused the video. So we know we have to find the delta pi value, but we know the delta f, that is the Ito's formula for geometric Brown motion, and we have the value of delta share, right? So we will put the value, right? Delta s, we will put the value, and let's make it here. So we have the fill. So delta pi equal to minus of rho f rho t plus s mu, right? Right. Rho f rho s parts da, I don't know what we said, partial derivative, and then half of square and s square of delta f delta s second order term plus the diffusion term s by delta f by delta s d dz, right? We have this term, and this odd term is in minus, and then we have our plus term, and delta s is the discretized version of GBM, right? That would be delta us delta t plus s delta z, and this is the discretized version. So here instead of d there will be delta z, and here instead of dt there would be delta t. Right, now it is recording, right? So if we open the bracket, right, so this clearly you can see that this term is can be subtracted directly, right? And the Brownian motion term, this term is subtracted, so the remaining term would be minus of s square minus of df or dt. That is our dynamics of our portfolio, and we know that our return would be risk free, right? Risk free, so our dynamic would be equal to r pi in delta t, right? That would be our main assumption, yeah, of risk neutral one. That would be equal to the risk free rate by portfolio value with change of time, right? And now we will put all the value in it, and our dynamics value would be minus half square s square df ds square plus df ds would be our portfolio value is minus our portfolio minus f minus s, okay, and that would be our respect to dt. So this minus would be cancelled out if we open this bracket and we put this term here. That would be 1 upon s square delta f square upon, here this term will come in positive r. Let's put this term here. I'm just rearranging the order to make it look like it is in the textbook, and r minus sorry r, that will r rate of change of time, rs, and this is equal to rf, right? Delta t, delta t is gone, I guess. Yeah, so this is our bs differential equation. Rate of change of time with respect to time, the second order term plus the risk free term, drift term, you can understand. And that if we solve this sd with boundary condition, like for core option, that is max of st minus k, right? For output we arrive to a Black-Scholes formula. That's how it's done. And there is a called a perpetual derivative. So it is a type of derivative whose payoff would be fixed of q amount, and would be only if spot price is equal to one h price, let's say h. If it hit that barrier, the payoff would be only q. So we can convert this bs differential equation, partial differential equation, into ordinary differential equation with keeping the boundary condition. So our upper boundary condition would be if h is greater, if s is lower boundary condition would be if s is lower than the h, our function, our derivative value would be 0, and our stocks value, if it is 0, and f equal to q. If in this case our payoff would be h equal to h, right? And our then in this case our value of a function is would not be rate of q upon q into s upon h, right? And let's solve the boundary condition for h greater than h. The derivative price is f equal to 0, and if f equal to q and s equal to h, our function value would be q s upon h minus alpha, and alpha is where alpha is the positive value and alpha value is given by 2r upon sigma square, right? And that's the value of derivative, that the final value of derivative would be this. And let's talk about price of tradable asset. So the price of tradable asset, any asset or any function of derivative or that can be differentiated using PS and have a solution, that is tradable asset, right? And if it don't have solution, like s of n, that do not satisfy differential, because log form exponent is not differentiable, right? uh, f s of n do not form the condition of follow the condition of differential equation, then it cannot be used as a process for BS and cannot find the solution. On the other hand, we can find the solution of this, because here it is depend on spot price, like that something. And risk neutral, what we assume that, so our pricing of any derivative would be required of 3 steps. First, assume the payoff risk free rate is R, right? The market is risk neutral. Then find the expectation of XP, yeah, future value of, calculate the payoff of expectation of AST. Then discount it to today's cash flow, and that how you find the payoff of a function. And that's all. And let's see application of BS in forward contract. So we know the forward contract payoff is ST minus KF. If we have to find the value of derivative, that would be discounted value of our expectation, right? That's simple it is. And if we solve the expectation equally, if we open the bracket, and we know that expectation of ST is equal to SO dot ERT, right? And after minus RT, that into SO dot ERT, this term plus this term will cancel out, and we have our formula SO minus K E minus RT, and this is argument of 5.5. You can see in the chapter, and that's simple. It is how we can derive the price. And now we are on the BS final formula, right? That would be core price would be ST SO CDF. N is the CDF, the community CDF of CDF, and K is strike price commutative distribution function, and that would be N upon D2, and our put value would be as simple as it is. It would be the minus value of everything. Awesome. That's the our current put BS formula, where D1 is log of SO upon K plus R, right? Where R plus sigma square upon 2 times T. My PC is lagging again. And divided by sigma T, and D2 equal to D1 minus sigma root T. That's it. And all the function is normally distributed, all the variable is normally distributed, and rest time is okay. That's the BS formula that we use. Now we understand the term. So what does n d1 and n d2 mean, right? For n d1 n d2, it is simple interpretation. It is a probability of call price for option will be exercised. It is a probability of call option to be exercised. And for ND1, it is like the term SO ND1 discounted ERT, right? It's expected stock price at time T in risk neutral world when stock price is less than strike price. So first is the probability of exercising, if that means the stock price ST is greater than K, and SO and D1 ERT is the expected stock price where where stock price is less than the strike price, counted as a zero, where the function or value of derivative is zero, and that's simple it is. And yeah, you all know that. And properties of so if SO, so one of the parameter assumption, yeah, properties of BS is if SO is very large than a strike price, that means the probability of stock exercising is will be more than one, right? Will be close to one, so it would be converted into a forward contract. So that's you have to remember. And for a put, it is just a negative of D2 and negative of D1, so opposite of any variable. So yeah, and BS, where it is depends on stock price and volatility. Second mode of return, that is volatility. Okay, so you can understand as a BS formula of not pricing stock. It is like pricing the underlying given the price of derivative in term of underlying. So you can understand as underlying. So pricing the underlying as given and pricing the derivative in term of underlying stock, in term of underlying stock. Okay. And yeah, warrant. So warrant and warrant and stock option. So when it is exercised, new stock is allotted and the value of stock goes down because there is more stock in market. For a normal call, European call and put option, the stock is traded. The derivative is traded, not created. For employee, it is created. And yeah, so for total depreciation in stock price or a depreciation in stock price, where M is total cost of option and there is no benefit for company for issuing warrant, and N, our N is, let's say, so M is new stock created, N is total number of stock company have, so dot option price. So for a new warrant option, that fair value of option price would be will go down to this amount. That's the important formula you have to remember. And let's talk about another very important and last important thing of this chapter, implied volatility. So the BS volatility is not historical volatility, it is forward volatility or volatility of option. The implied volatility, you can think at the volatility caused by option, not the historical volatility, volatility of option, right? Trade in practice, the trader implied volatility implied by option price observed in the market. So volatility implied by option price observed in market, and that is a forward looking, and we find the implied volatility by using BS formula where we have the volatility, right? So we observe the market price. Let's say market price of option is 2, and we put all the value SOK, and what more value we put, risk free rate, right, in the market, and then we match. It is basic algebra, right? So let me give you a proper area. The model used in this is Black 76 model for implied volatility. And let me explain you in simple way. For let's say for D1, right? Log of SO K plus R sigma square 2 and T. And let's see, so we will put all the value of market value of SOK and R, and market option price. So we have a option price too, so we will not put the value of sigma, and we will find a interpolation or for loop in. So we will find the iteration for best possible value that would equate this equation. Let's say if sigma value 25 and the value is 1.76. So we will increase our sigma guess to 30, then it will close to 1.96, and for 35 it is exactly 2. So our implied volatility is 35. And one of the most important method is used as a Newton-Raphson formula. So in this we start from random guess, that would be, let's say, sigma hat equal to 25. So 1 minus sigma equal to sigma hat. So we will give a condition and we will put this value in our BS formula, and then we will get the value. And I can show you this in my one of the project. Okay, so first we have the market parameter, right? Vk equal to 2, strike price, time to maturity, r, sos, sigma, initial. So with initial we start from 25% of market, and call type is this, and this is black 76 model, where we define the minimum error rate, the convergence rate, option price, and vega is rate of change of volatility with respect to time, right? N is one iteration, we start from one, and we will end where our error is more than this, less than this, 10 into e raised to minus, very small number. And that is option price minus v market price, the price of from Black-Scholes formula minus v. And this is the Newton-Raphson formula. And yeah, and that's it is a Black-Scholes formula. This is the Black-Scholes formula, where it is. Yeah, you can understand d1 value, d2 value, and if norm we used SciPy library for calculating CDF, and you can understand as a CDF of x, right? It is all the possible value till below before x. So let me show you in proper way. So the probability of random variable, that would be less than x. So n upon x means that the CDF is a probability of random variable that will be less than s till here. And yeah, I covered that, and let me show you the application. So current stock price, market observe price is 2, and initial guess is, yeah. So calculate. So implied volatility is of 16%, and we took 6 iteration, and at 6 iteration with sigma value of 0.16, our option price came 12, and that's how it's done, and it's simple, right? And I cover warrant, I cover, yeah, VIX index. So VIX index is a volatility, implied volatility index of option. So it is more like inverse of option. If the market there is a huge jump, then the VIS index would go high, and it is used for hedging, hedging our risk and dividend, right? So when dividend is announced, our stock price goes down, right? So for pricing dividend option, so it is very easy. You just discount the dividend, and the discounted stock price would be passed into BS formula, and then it will give us option price. That's how, that simple it is, and the market correct itself, so we don't have to discount it again or any, we have to do anything more. And yeah, that's what it was, my sum up of this BS Black-Scholes Milton model. And I hope you understand it. Go go through this chapter once more time and try to understand as much as it possible. It took me 3 to 4 days just to understand this chapter, and it frankly I am not so good into activity, so I will do this chapter again, and I hope you will do this chapter very well, because this is one of the most important chapter you can think of. And thank you for watching this video, and please comment anything you want, any suggestion or anything. I am very happy to respond to your comment. Thank you for watching. Bye bye.